Okay, let's get to hot picks. Our guest has three stocks on his radar he said could be winners in a weak consumer environment. We're joined by Ernest Wong, Head of Research at Baskin Wealth Management. Great to talk to you once again, Ernest. Thanks very much. And you do say there's a real risk here that consumers will pull back. Are you talking about both US and Canada?
Right. I think in the US especially, we are really seeing the low-end consumer struggling. Yesterday, we saw McDonald's say that the low-income consumers were spending double-digit declines at their restaurants. So really trying to pull in and squeeze every dollar that they have.
Right. Your first idea here is Live Nation, much maligned, obviously, over high ticket prices, but you do see potential as an investment.
Yeah, so Live Nation has concerts have historically been one of the most recession resilient forms of consumer spending that exist, because going to see your favorite artist is really an irreplaceable experience. And people are willing to cut restaurant spending, they're willing to cut traveling, but they really do want to see their favorite artists perform live. And Live Nation is at the center of all of that. They've built up their business. They're increasingly now owning the venues as well. And the stock has, the stock has slipped a little bit yesterday on earnings, but we think that they have a lot of growth ahead of themselves.
That's interesting. I'd forgotten that. They're actually buying up venues. I mean, talk about vertical integration.
Yeah, so the strategy with owning their venues is that they can capture more of the ancillary revenues that go around the event, such as selling beer, providing the parking, and also being able to provide concert infrastructure in places that historically may not have an arena or a stadium built up, so that artists are able to perform in those places as well.
Your next idea has the symbol DPZ. Tell us what they are and why you like them.
So DPZ is Domino's Pizza, which is the largest pizza chain in the world. They are pizza is one of the best categories in all of fast food, because it really is a very affordable way to feed an entire family. Domino's Pizza has done a terrific job over time of gaining market share, both against larger chains and independents. And we're seeing some evidence of this week, where Pizza Hut is reportedly for sale. We think that this is a very high quality business that is trading at a very reasonable valuation.
Why has the stock dropped, though, over the past while?
Yeah, I think it's just ongoing concerns over the lower end consumer as well. Certainly, Domino's is not immune to these challenges, but what we like about the business is that they have a lot of levers to be able to drive growth going forward. They revamped their loyalty program. They signed a partnership with DoorDash and Uber to really tap into that aggregator market as well. And so we think that these will continue to drive growth going forward.
And finally, Costco. We know about their loyal consumer base. What else attracts you to this one?
So Costco does well in good times and bad times, because in good times, people are shopping more. In bad times, people want to shop at Costco because they have the lowest prices. And so Costco, out of all the retailers that exist, have the most consistent same-store sales growth. And we saw that last night when they reported their figures for October. They were very, very impressive. I think 8% same-store sales growth. And we think that they have a lot of opportunity to grow their e-commerce business, to open new stores in both the US and in international markets. And more recently, they've been launching into selling third-party ads. So using the consumer data that they have on the things that their members are shopping, and using that to drive sales as well.
It's so interesting. Companies like Amazon are leveraging their huge internet presence to sell ads, and Costco's jumping aboard that.
Exactly. And Costco has been relatively late to recognizing this potential, but we think that they have a lot of upside as they continue to build out their e-commerce and really start to use the data that they have on what their members are shopping within the stores to make targeted ads.
Ernest, before we let you go, two stocks that you watch are Canadian Natural and Tourmaline. Any thoughts on the latest numbers from Canadian Natural?
Yeah, so Canadian Natural had good production. Oil prices were a little bit weak this quarter, but what we like about Canadian Natural is that they continue to find ways to consistently grow production in a low risk way. So yesterday or earlier this week, they completed the swap with Shell to gain full ownership of the Athabasca oil sands project. Mm-hmm. So really adding production in existing properties that they are already very familiar with. And these are assets that they understand and are very, very low risk forms of growth for the business.
And then just finally, we're very tight for time, I'm sorry. Tourmaline, what are your thoughts there? Would you be a buyer of this stock?
Yeah, so Tourmaline, we've been in a period of weaker gas prices lately. I think the market's concerned about the lower special dividend, but we think that they're very well positioned for LNG going forward and are building the business up the right way for that.
And they've announced a 10-year supply deal with the Brits, the British gas owner Centrica. Thank you very much, Ernest, as ever.
Thank you.
Ernest Wong, Head of Research at Baskin Wealth Management.